Meb Faber, Cambria is out with a brand new shareholder yield ETF, the SYLD. How is this different from other dividend ETFs out there like the DVY?
We think just focusing on dividends is one of the most basic mistakes an investor can make. If you look at cash flows, what a company can do, there's 5 things they can do. They can pay a dividend, they can buy back their stock, they can pay down debt, they can reinvest in the business, or they can acquire another company. And that's it. And so only focusing on one of these metrics of cash flow, dividends, really ignores the others, and especially buying back stock. So we think it's a big mistake just to focus on dividends.
All right, so what are the requirements for a company to make it into the SYLD?
So we look at being agnostic between dividends and buybacks because really they're the same thing. If a company's trading at intrinsic value, and dividends are actually a little worse on tax basis. And so we look for a minimum yield of 4% across dividends and buybacks. Then we exclude a lot of the more expensive companies because you want a company to be trading below intrinsic value. And then we look for the highest on shareholder yield, which also incorporates debt pay down. So then it's basically cheap companies that are giving back their cash via dividends, buybacks, or debt. And then we use one final sort, which is momentum, because we don't want to be buying the cheap companies that are still declining. We don't want to be buying a falling knife. So we want to be buying good companies for cheap that are going up.
Those are some pretty steep hurdles, pretty high. So which companies right now are clearing that bar?
Our biggest sector is financials, then industrials, but financials about 20%. And we end up with a lot of names people would recognize, AOL, some of the Home Depot and Lowe's, these types of companies. And overall, you end up with a portfolio that has a buyback and dividend yield in the high single digits, but also cheaper than most of the broad indices.
And how often do you rebalance this portfolio to make sure that these companies are clearing those hurdles?
We do it quarterly. We don't expect too much turnover, but the momentum requirement gives it a little more probably than most of the traditional dividend funds. But yeah, it's a quarterly rebalance.
And it's momentum, not management. This is purely a quantitative fund. Do you take management into account at all?
Quantitatively, we look at management. So buybacks in general, people do it really poorly, the timing on aggregate. If you look at 2007 when companies were buying back stock hand over fist. And the problem is you want companies that have a systematic approach that are buying back their stock when it's cheaper. So by screening for cheap companies, then looking for buybacks, we think it's a much better way of finding management that's doing the right thing rather than buying back their stock when it's much more expensive.